So, hello everyone. Matt Piepenburg and myself, we're back for another MAMChat. And Matt, this is going to be a serious chat, or it's even serious discussion, because what's happening now in the world, I think we're looking at something which is much worse than the 70s, which I remember well. You know, I was in the UK at the time. We had the same type of problems. We had an energy crisis. Was a Middle East oil crisis. In the UK, there was coal miner strike. We had 3-day week. We had inflation of 15% for about 7-8 years, average. High interest rates. As I said many times, my first mortgage was 21% for a while in 74. And we're going the same way now. But this, Matt, is on a global scale. And you know, it's on a scale that I don't think the world can cope with. And you know, we have two problems here. The one is financial markets, and the other one is people, individuals. And if we start with individuals, everywhere now in the world, the Western world and developing countries, there are problems with, you know, they can't afford food prices, can't afford to eat properly, they can't afford to heat their homes, they haven't got enough fuel for cars or vehicles. And that's getting worse. If you listen to television, to interviews with ordinary people, they're not coping today. And it's going to get worse. At the same time, in some countries, taxes are going up. So we're going to have a problem on a massive human scale here in the West and developing countries, even worse so, because they're not going to get their food either, and nor do they have any money, of course. So, and that's happening, Matt, at a time when the whole financial system is under tremendous pressure, and there's a bubble well, the whole of the system, we know, of course, is due to debt explosion in the last 20 years, where debt has trebled, global debt. On top of that, we have derivatives. And we're seeing the pressure now in financial markets. We're seeing the pressure in the bond markets. We saw UK just announced a new budget with some changes, like half a percent or 5% lower tax for the wealthy, and the bond market collapsed in the UK, and the Bank of England had to come in and support the market to the extent of £65 billion a package, and of course the pension market also was on the verge of collapsing, because pension funds have bonds, or gilts, as we call them in England, and they have stocks, and the stock market is crashing, the bond market is crashing. So that's the situation, and that happened in the UK, but it just shows that the whole system is on the edge of a precipice. And you know, it's not just, I mentioned the UK as an example, it's the same everywhere. I mean, the Fed had an emergency meeting in the last couple of days. Have we heard anything from that, Matt? Because it's a secret meeting, isn't it?
No, it's a response to this kind of UN call that all central banks need to put the brakes on rising rates, that it's just crippling currencies all over the world and pushing the dollar too strong, and the ripple effects of that are devastating. I think also the fears of another Lehman moment out of Credit Suisse have got citizens around the world thinking of another 08 type of moment. I don't know if you have any thoughts on the Credit Suisse problem. I certainly do, but that's just one more skunk in the woodpile right now.
Yes, well, I've followed Credit Suisse for quite a while, as you know, because Credit Suisse, of course, has had problems now for years. I mean, I was just looking back at the write-offs they've had just in the last, let's say, less than 10 years, last 7 years. They have written off or lost reserves of about 20 billion. You know, they've had one crisis after the next. They've lost on investments. They have lost. I mean, the big one. Well, they had In America, they had a big mortgage mis-selling. They had to compensate the market with several billion. And then, of course, you had the Greensill, which is an investment vehicle that they finance and set up. That went totally wrong. And that was, I think, another 5 billion. And then last year, we had this Archegos, which was an American hedge fund that had massive credit lines on very leveraged speculation with all the main banks, this is called prime brokerage, and they were financing this relatively small hedge fund to an extent that when it went wrong, and it did go wrong, the losses were over 10 billion.
Yeah.
And Credit Suisse has had one of the biggest exposures, as usual. They're up there. And they lost around 5 billion.
Yeah.
And of course, in Credit Suisse, we've seen now that the share price has gone down 95% since the peak. The shares are standing at about a quarter of book value. But of course, Matt, we know you and I, book value with the banks mean nothing. It means nothing because most of the banks are not going to collect anywhere near all their loans and all the claims that they have in the balance sheet. Yeah. So, but it's no bank is worth book value today, and Credit Suisse obviously is expected to fail because its share price is standing at a quarter of book value.
Yeah. And
then you have, as you know, the credit default swaps. That's a way of insuring the bonds of a borrower. And credit default swaps is like an insurance derivative contract, and they're also, they're being priced at basically junk.
Yeah.
So, and of course, on top, UBS a little bit better, but not much. Yeah. And of course, Credit Suisse, we've seen it's like been a revolving door of management. Every year they've changed the chief executive and chairman very often also. And now we have a new team. Sadly, I can't see them saving the bank. But the Credit Suisse won't go down first, just like Deutsche Bank won't go down first, Matt, because the central banks are not going to let the big banks fail initially. They can let the smaller banks fail, but not the big ones. So they will obviously print more money to save them. And we know there's a crisis in the banking system. We knew that. You and I talked about that 2019 in August, September, when the US started printing money and the rest of the world. So there is a massive crisis, and it's going to get worse in the next few years. Mm-hmm. So that's the background. And you take central banks, they haven't got any money either. The Swiss National Bank is the biggest hedge fund in the world. So they will print money. I mean, Switzerland is a very strong economy and the strongest currency. In the last 50 years, it's been the strongest currency. And I'm having started working for more than 50 years ago, I know, I remember it well, but still, they will have the same pressures as every other country. Yeah. But of course, currencies play a big role in this also, Matt. The dollar has been extraordinarily strong now, artificially, I would say. So what do you think is going to happen to the dollar and the effect on the gold price, etc.?
Yeah, there's no denying that the correlation to a hawkish Fed and rising Fed fund rates and a strong dollar is undeniable. So as Powell tries to revisit the days of Volcker and pretend that he's going to fight inflation with rising rates, he's made the dollar incredibly strong relative to other sick horses in the glue factory. We're still the strongest right now, and we can be because we're the world reserve currency, and the Fed has this immense power, which we can't underestimate. We now respect their policies, but we have to respect the power of the Fed. But a strong dollar is basically killing every asset class in its wake, except for the US dollar, in a sense. And you've seen that in the US markets and global markets. The NASDAQ 100 looks like it did in 2000. It's the same kind of chart patterns. The S&P's in bear territory. The the standard 60-40 stock bond portfolio, which is the bread and butter of RIAs across America and portfolios for every kind of retail investors at lows it hasn't seen since 1931. So, and then of course, mortgages in the US, as rates go up, as the Fed funds goes up and the dollar gets up, mortgage rates are just shy of 7%. So that's blistering the housing asset class. And I think anybody who has a job refinancing mortgages or issuing mortgages is going to be looking for work very soon, like so many others in a recession.
But
So
I
the
mean,
strong,
just to stop, yeah, we just if we just look at the mortgage rates, we know that for most people they're already up 2-3 times
yeah,
in the last 6 months.
yeah.
And that's when talking about people not being able to cope. That's more than anybody can actually finance or pay out of their income.
Yeah,
So yes, I mean that's a massive dilemma, and again another human dilemma.
yeah, the ripple effects again are enormous. I mean, we talked about this over the summer in my little town here in France. An elderly woman was talking to me on the street because there's now a charge for taking your trash to the public trash dump. You have to use a card to open the trash. And that may seem like a minor cost, but even that minor cost was putting someone nearly the edge. And this was over the summer. Now, with energy prices, gas prices, fuel prices, I mean, the average person is really getting clipped. And as I said, this strong dollar doesn't just stay contained in the US. It has impacts all over the world, in US markets, of course, but also in other currencies that are tanking. But of course, as gold experts or executives, we also know that the strong dollar has been a real headwind for US price gold. It's important for American listeners to remember, though, that many of our clients are from the US, and in other currencies, gold has done incredibly well. It's only because the US dollar is strong that there's a current headwind on the gold price. But if you look even at the British pound sterling, when that's priced at gold, it recently hit new highs. So the US dollar.
When you mentioned the pound, so when we started with gold, I mean, I was partly based in the UK, and so gold was 2002 when we started was 200 pounds per ounce, and today it's about 1,530. So it's up 7.5 times. So you're saying, most currencies, gold has done extremely well, but temporarily not in dollars. Still not bad in dollars because you've gone from 250 up to well over 1,700, and but gold in most currencies has done better than any stock market in this century.
Absolutely. And even with the US dollar at these highs on the DXY, again, most of the DXY is the yen and the euro, and the yen's at 50-year lows and the euro's at 20-year lows. So again, the dollar is only relatively stronger. As we know, its inherent purchasing power since 1971 is down over 90%. So as a monetary money, gold is significantly better than any other asset class that we can think of in the last decades, and certainly even this year. But even this headwind on the US dollar price gold is, in my opinion, short-lived and short-term. And there are probably 3 simple reasons why it's, in my opinion, short-lived. The first one is simply we have to keep in mind that nearly $14 trillion worth of debt in the world is US denominated dollar debt. That doesn't mean it's all owed to a US bank. But whether you're in Sri Lanka, Lebanon, Venezuela, or even Tokyo or the UK or other emerging market to developing market economies, this strong dollar has to be paid back in weaker currencies, weaker peso, weaker pound, weaker euro. That's crippling these other central banks and these other economies. And there becomes a breaking point where emerging market economies can't debase their currency more or raise their rates higher to compete with the Federal Reserve. And at some point, these countries are going to cry uncle. So that's a real headwind for these third world countries or even developed countries. Japan had to sell treasuries just to get its yen back up, and the UK is doing the same. So the dollar doesn't live in a vacuum. Other countries and other citizens of the world pay the price for this.
Yeah. So where do you see the dollar going then in the next 6-12 months and longer term?
It all depends on how arrogant Powell wants to be in pushing the rates higher. And Powell has been saying, well, we're looking for a softish landing with a little bit of pain. That's really arrogant for him to say after the last 15 years, the central banks or the Fed has created the greatest wealth disparity in American history. The top 10% of the American population benefits from 85% of the stock market. So after blowing up this stock market bubble, making one class very wealthy, Powell has engineered the biggest bubble in our history. Now he's going to engineer a recession. because we know that rising rates are not going to fight 9 to 8% inflation. Even if he gets the Fed funds rate to 5%, he's never hitting neutral. The real play here is political. It's not honest. It's not transparent. So the question you're asking, when will it end, is really when Powell breaks enough backs of the economy that he has to pivot. It's not about fighting inflation. It's doing what he did in 2018. He wants to have as much interest rate height as he can get, so he'll have something to cut when all else fails, so that he'll be able to reduce rates in a real crisis. This narrative, in my opinion, that he's raising rates to fight inflation is absolutely disingenuous. And the other thing, for him to talk about a hard landing, well, that's really easy for him to say at his income bracket. But for the middle class, inflation isn't a hard landing, it's crippling. It's not just disruptive, it's crippling. And so it's really a disconnect between the real people and the policymakers. I also think we're not going to have a soft landing with 8% inflation. In the history of recessions, you've never had a soft landing once inflation's above 5%. So Powell has to know this. What's remarkable is the disconnect between his honesty and his political talk. The Fed isn't independent. It's a political beast. It's probably the most political entity in DC, the most powerful. And so to answer your question, Egon, it'll break when the economy breaks to the point where Powell finally pivots and starts reducing rates into a real recession. We're already in one, but when it becomes undeniable, he'll start reducing rates and weakening the dollar, because that's the only way to get out of a recession. Once they decide to call a recession, he'll reduce rates and weaken the dollar. And then, of course, the gold headwind will become a massive tailwind for US dollar price gold. It'll be an epic moment for gold.
But isn't it now the fact that I don't think that dollar is strong because of high rates. I think the dollar is strong because there is nowhere else to go for weak currencies in the world. The yen has been weak for a while, and the Japanese economy, as we know, is just living on borrowed money and printed money, and it has for years and years. And it's been amazing that the yen has stayed strong for as long as it has. The EU and the euro is in a total mess, isn't it? And that banking system is also on the verge of collapse. And therefore, really, money is, and the pound and the UK has their own problems also, as we've seen in the last few weeks. So the money has nowhere to go but into dollars. Isn't that is just the worst of a very bad lot, isn't it? These currencies.
Absolutely. You can't just blame the Fed for everything. You have to look at the Japanese central bank, the Bank of Japan under Kuroda all these years. They invented quantitative easing. Bernanke taught them how to do it before he was a central bank Fed chair, but he came over with the playbook to show Japan how to use the money printer. And the Japanese have been completely addicted to that. And all this QE to buy their own bonds, their JGBs for years, has deflated and debased their yen to the point where, again, they're at 50-year lows against the dollar. And what has Japan had to do, as they're on QE and overdrive still to monetize their otherwise dead on arrival bond market? They've printed so much yen that it's lost all its power. And so they've had to sell treasuries into the Forex market to try and boost the yen from a totally embarrassing collapse. The British pound sterling is going through a similar thing. The euro will too. In many ways, I think the UK and Brexit was thinking further ahead, though. They're being more honest. They left the EU, which is breaking, and they're admitting to QE right now, because that is the only solution. If you don't have GDP and tax revenues to survive, you have to create money out of nowhere. And the UK, the Bank of England, has just printed. Soon enough, the European Union will too, and eventually so will Powell, because the world is in a debt crisis. And and the central banks are going to print. And to your point and to your question, I'll go back at you. We know that money printing is kind of a mug's game. Predicting markets is kind of a mug's game with precision. It's going to rain. We need an umbrella. We don't know if it's going to rain at noon or at 3 p.m., but we need an umbrella, monetary umbrella. But in terms of this pivot towards lower rates and more quantitative easing, more mouse click money, I'm going to ask you, because the world's at 300 trillion plus in debt. The debt to GDP ratio in government debt in the US is 125%. In Italy, it's at 150%. In Japan, it's over 250%. So at some point, Egon, it's an unfair question, but what do you think breaks the camel's back here at the point where the system just has to revert to more honest, transparent dilution of money, more QE, more central bank support, which again is going to be a massive tailwind for gold in every currency, including the dollar? Do you see it fair to think of this 6 months, 6 weeks, 5 months, 2 years, Q3, Q2 of next year? Is it something that's kind of itchy on the back of your neck, or is it just too impossible to time the insanity right now?
Well, the markets will tell us, of course. You coming back just on the currencies, it has been a race to the bottom since 1971. And all currencies have lost 97, 99% against gold, which is the only money which maintains purchasing power. And what I see now is that, and of course, all currencies can't go down at the same time together. They have to go, the way we measure them, they had to go one against the other and take turns. And the dollar is now temporarily strong. Well, the whole of this century, and of course, it started in earnest in 2006-07, and with the crisis in 2008, that central banks miraculously saved the system, and they did well there by printing trillions of dollars and guaranteeing, and that gave the world a stay of execution. And this is now what is coming back and hitting us 10 times worse than it would have been if the world had collapsed then. So we have more debts, probably we're not seeing the real figures, but probably derivatives in the around 2 quadrillion, I estimate. And that in itself is a ghost that will haunt us. Because well, they're going to print money for that also when it starts collapsing, and it is collapsing. That's all we see now. Interest rates problems that we are having now, that really comes back to derivatives, because every interest rate in the world is linked to a derivative, not to a real market.
Right.
And therefore, and that's what is so much under pressure now. There's the whole of the derivative. On top of that, you have the energy derivatives, of course. So I think derivatives will be part of this collapse that I have always been convinced will come. But before that, we will see massive money printing, higher inflation, and they can't stop the inflation. There's no way. Whether they have temporarily higher interest rates will make no difference whatsoever, because the runaway inflation, and I saw that in the 70s. You remember, we had in the UK, we had high inflation, and we had high interest rates, and deficits. And that was in one country. We're going to see that on the global scale now. Right. I think it's all going to now happen in the next 6 to 12 months. I think 23 will be a very difficult year for the world. On top of that, we have, of course, the geopolitical situation, which we haven't even discussed, Matt. And the war in Ukraine, there is no will anywhere to stop that war. Right. The US wants war, sending more weapons, more money, and some of that money might reach the country, and too much is probably reaching the politicians and others, because Ukraine is, of course, seen as a very corrupt country. And then you have the energy shortage in Europe is a catastrophe, total catastrophe. We will be back in Europe, in most countries, to the 3-day week or whatever it will be, like we had in the UK, that we only had electricity for 3 days in the 70s. That will come back again, and the sabotage of the Nord Stream, the pipeline from Russia, gas. I mean, that is, nobody knows who's done it. Not very few have the capacity to do it. And of course, America, not just Biden, but also American officials made it clear earlier this year that they have means of destroying that pipeline. So they made it clear that they would do. So that's as Russia saying it's an act of war, and it is. And of course, so there is a war already. And here's another, and America is now escalating it, and no one has any interest in talking peace. And that's what's so sad with this, because it's possible. I mean, one shouldn't let a small country start a world war, and potentially a nuclear world war, But of course, it's always been the case in history. It always starts with a small country, but it's actually the big powers which are always behind. It's not the small country which is causing.
Yeah.
So you add that to the pot, Matt, and we're having. I mean, because the war is not going to stop.
Yeah.
It's actually escalating, and of course Russia is now under pressure, and they're not going to accept that, so they will do whatever they can to now win back what they lost in land, etc. And whether they'd use nuclear power or not, I hope not, but you never know. So this is now very dangerous. So we already have an incredibly dangerous financial situation in the world, which is going to explode first and then implode, and then you have the war on top of that. So sadly, I think we're going to have a very difficult year 2023. And it'll probably start this autumn also. Stock markets came down. They had a little bit of a correction up in the last few days. That's temporary. We're going to see the next crash, in my view, coming soon, and the longer trend is down substantially. And I will stand by my projection that before it's finished, markets will be down 75 to 95% and take a long time before they recover.
Yeah. Yeah, sadly, Egon, I think you're right. We have a sandwich of economic catastrophe and geopolitical catastrophe. The statesmen we have in play today, left, right, or center, are simply not what they used to be. There couldn't be a weaker midget class of intellectuals in the West trying to effectively avoid any chance for peace. Even in the Cuban Missile Crisis, Kennedy and his cabinet were smart enough to give Khrushchev a gentle way out, a face-saving way out. That doesn't seem to be the desire now. And a DC that's beleaguered and looking for a distraction. War is a classic distraction of U.S. policy during economic crises. Let's hope cooler heads prevail, but I don't see it right now under current policy at all. And when you combine that geopolitical risk over a country like Ukraine that could send the whole world into a tailspin, it's just unfathomably, unimaginably, appallingly stupid. And yet, that's on top of this massive debt, raising rates, steady inflation, collapsing bond and credit markets. These are no longer exaggerations. These are what we are seeing today. It's no longer even a prediction. It's just how long can a money printer keep the facade of productivity alive? And that's all we have, sadly. And of course, currencies will fall. And this is not a gold bug argument. It's a simple reality. Real money will prevail, as it always does in these types of crises. So,
yeah. So sadly, we can't bring good news. Because the situation is worse than I think any time in history.
Yeah.
Because we never had problems on a global scale like we have today. We've been more isolated, and you could save a country or region, but you can't save the whole world financially. And on top of that, if you get a war or a geopolitical situation, even less so.
Yeah.
So we have to say, then what can people do? What can we advise people to do? Of course, number one, gold and silver is going to help people. It's not the solution to the problems, but it at least it's some insurance, because we know absolutely guaranteed that the currencies will now accelerate down. Even the dollar. The dollar might be temporarily stronger than the others, but the dollar is not going to be strong. And the falling currencies will be reflected in the gold and the silver price. And they have now turned up again, and gold is going to start going up very fast. And silver will go up 2 or 3 times as fast as gold, as it always does. But silver is more volatile, so people should be careful of having too much silver, because that's very speculative. Gold is the king of the metals. Yeah. So people should have some gold. You don't have to be rich to own gold. You can buy an ounce or a gram of gold for $50, $60. So it's not just for the wealthy. And the same as silver, of course, you can buy now an ounce of silver for $20. So everybody can save in metals. And if the Venezuelans had done that 10 years ago or 15 years ago, they would have been all right, the ones who did it. And now they're all destitute. And of course, if you have bigger amounts of gold or silver, don't put it in a totally fragile and fractured banking system.
Yeah, for sure.
But you know, put it outside the banking system in safe walls, because you cannot depend on the banks, and one day the bank will be closed and you can't get to your goal if they even have it. The other thing, of course, is, as we always say, Matt, is what is important in these difficult times will be family and friends, and that's your big support group. And that's really what people should think about, because that's what's going to help us all through this crisis.
Absolutely, undeniably. I'm instead of shuffling money around these days, I'm shuffling daughters and sons and friends and family around, so we spend more time together and try and coordinate that. It's as important, of course. Financial comfort and stability is essential in these times, but it just forces priorities to the forefront. And our real wealth is invisible. Ultimately, it's, you know, that's not, it's not something that's a surprise to most of us. You know, we do this also, we can be close to the people that matter to us and help them when we can, and be helped by them, and cooperate as a group.
Helping others will be so important.
Yeah.
Matt, so we spent half an hour or so talking, but I think this discussion has been very important, because people have to be aware that we are now on the cusp of something very, very difficult for the world, and you know, it doesn't mean that if you are prepared for it, that you're going to escape it, but at least you are psychologically prepared and mentally, which is very important.
Yeah, sadly, these are not sensational times. These are real times. I mean, this is how it really is, and let's just be realistic about it. You know, it just is.
So we will come back soon again and discuss. I mean, I'm sure that these problems will unravel now very quickly in financial markets, certainly. So we'll be back again with our view on that, Matt. So thank you for this time, and thank you to our viewers and listeners, and we'll see you soon again.
Okay,
Thank you.
talk soon, Egon.
Thank you.